You're paying $4 a gallon at the gas pump right now.
Yeah, at least.
Right, and inflation is just relentlessly eating into your paycheck. I mean, there's literally a naval blockade in the Middle East. The world feels incredibly unstable right now.
It really does. It's a very tense time.
But then, you open your retirement portfolio today, or you just glance at the financial news, and the S&P 500 is shattering all-time record.
Oh, totally breaking them.
We are living through this massive cognitive dissonance.
Yeah.
It's a total paradox.
Yeah, it creates this psychological whiplash for the average investor. You have your lived experience on one side and the ticker tape on the other. And I mean, they seem to be describing two entirely different planets.
Exactly. And that disconnect is exactly our mission for this deep dive. We are unpacking this massive stack of 2026 outlooks from heavyweights like Morgan Stanley, Goldman Sachs, JP Morgan, and Charles Schwab.
Huge reports.
Yeah, plus some really interesting reporting from CBS News and economist Justin Wolfers. Our goal today is to give you a clear summary of this current market, decode exactly why it keeps going up despite high gas prices and, rising unemployment fears, and basically evaluate whether a crash is looming.
We need to figure out what the smartest institutional minds are advising right now.
Right.
But just a quick caveat for you listening before we get into the actual mechanics of this. A lot of the data in these reports intersects with some pretty highly polarized politics.
Yeah, that's unavoidable right now.
Exactly. Specifically, the recent One Big Beautiful Bill Act, or the OBBBA, and some intense presidential rhetoric regarding the Middle East.
So we need to be really clear here.
Right. Setting all the partisan noise totally aside, we are strictly analyzing the mathematical and market impacts these policies trigger. We aren't taking political sides or endorsing any viewpoints at all. We're just, following the flow of capital.
Beautifully said. So let's start with the sheer scale of the rally, because the numbers are staggering. According to CBS News and Goldman Sachs, the S&P 500 hit 9 separate record highs in May alone.
Wow. 9 in 1 month.
9. And the target predictions for the end of 2026 are aggressively bullish. I mean, Goldman is projecting 7,600. Morgan Stanley is targeting 8,300.
That's a massive jump from where we are.
It is. So how do we square those numbers with, like, a Middle Eastern naval blockade and fears of a global energy shock?
Oh, well, you have to separate how human beings process trauma from how financial markets process risk. Economist Justin Wolfers framed this brilliantly in his recent segment.
Oh, I loved his analogy.
Right. He pointed out that markets don't necessarily rally because the news is objectively good. They rally when the news is simply better than the apocalyptic scenario they had already priced in.
Yeah, Wolfers used that great analogy about his childhood report cards.
Yes, the report cards.
It's like if he brought home a C grade, but his parents had already braced themselves for a D, that C suddenly feels like a victory. The market is basically operating on a C grade economy right now.
Okay, let's unpack this. Is this entire record-breaking market just a massive relief rally because the world didn't end?
In the short term, yes. Look at the JP Morgan data on the recent Iran conflict for the perfect real-world application of that theory.
Okay.
A couple of weeks ago, the market was pricing in a worst-case scenario regarding the Strait of Hormuz blockade. I mean, institutional models were bracing for oil spikes, massive supply chain failures, basically a total energy shock.
Right. Not to mention the presidential rhetoric at the time was literally threatening civilization-level destruction.
Exactly.
The market was looking at a potential F grade, like end-of-days territory.
Right. And consequently, we saw a near 10% drawdown in the equities market as capital just fled to safety.
People were panicking.
But the moment that extreme rhetoric paused and a diplomatic off-ramp seemed even marginally possible, the market just breathed this colossal sigh of relief.
Wow. What's fascinating here is it took only 11 days to execute a complete V-shaped recovery and erase that entire drawdown. 11 days.
Just because it wasn't the end of the world.
Exactly. They didn't need good news, they just needed less bad news.
But I mean, a released rally is just a sugar high, right? The absence of a nuclear winter or a total energy collapse might trigger some short covering and algorithmic buying for a couple of weeks, but it doesn't sustain month after month of record-breaking all-time highs.
No, it definitely doesn't.
There has to be actual fundamental fuel in the engine to push the S&P to 8,300.
And there is. The fuel is corporate earnings, and they're moving at a velocity we rarely see outside of like post-recession rebounds.
Oh, really?
Yeah. CBS News highlighted that tech sector earnings grew by an astonishing 50% in the first quarter.
50%? That's insane.
It's massive. And perhaps more surprisingly, non-tech earnings grew grew by 20%, which is double their historical baseline. JP Morgan actually notes that 83% of companies are currently beating Wall Street's estimates.
Okay, so wait. What's wild is that despite the S&P hitting these record highs, the price-to-earnings multiple actually compressed, right?
Yes.
Because Goldman Sachs points out the PE of the S&P 500 dropped from 23 down to 21. That means earnings are outrunning the price action so fast that the market is technically getting cheaper while simultaneously breaking records.
It's a totally remarkable phenomenon. When the E and the PE ratio grows that explosively, it compresses the valuation multiple. You are literally paying less for every dollar of corporate profit today than you were 6 months ago, even at these record index prices.
But a massive chunk of that bottom line padding is coming from the corporate tax breaks baked into the OBBA, isn't it?
It is a significant factor, yes.
Because when you slash corporate tax liabilities, net income just spikes automatically without the company having to sell a single extra product.
Right, it's an immediate bottom line boost.
But the real structural driver here, like the elephant in the room generating these massive earnings projections, is artificial intelligence.
Absolutely. Goldman estimates that AI is driving 40% of the S&P 500's earnings growth right now.
40%. Wow.
And the sheer volume of capital expenditure is unprecedented. They project that the top cloud computing and tech infrastructure companies will spend $670 billion on AI capex in 2026 alone.
Wait, $670 billion. Here's where it gets really interesting, because that figure sets off massive alarm bells for me.
How so?
Well, whenever I see multiple industries throwing nearly $1 trillion at an emerging technology in such a compressed time frame, I immediately think of the late 90s dot-com bubble.
Ah, right, the hype cycle.
Exactly. Like, is this just another dot-com bubble where everyone is paying a premium for the hype, regardless of the underlying business model?
It's a very valid concern, and Charles Schwab's 2026 outlook validates that exact fear. They specifically warn institutional investors about a dynamic they call circular financing within the AI ecosystem.
Circular financing. Let's unpack the mechanics of that, because it sounds incredibly deceptive.
It is a bit of a mirage, yeah.
It sounds like a casino staking a player with house money and then counting the player's bets as organic casino revenue. Like, it looks like explosive demand on the balance sheet, but the money never actually left the ecosystem.
That is the absolute perfect analogy to describe it. So you have these massive suppliers, right? Giant chip makers and cloud providers.
Okay.
They take their immense capital reserves and take equity stakes in buzzy new AI startups. Those startups, now flush with all this cash, turn around and use that exact same investment capital to purchase the cloud services and hardware from the supplier that just funded them.
Oh my God. So the mega cap supplier is essentially buying its own products through a startup middleman to artificially inflate its top-line revenue.
Yep.
Which then drives its stock price higher.
Exactly. It accelerates the infrastructure build-out, but it severely obscures genuine external market demand. I mean, it is practically a carbon copy of the vendor financing schemes that telecom companies used right before the dot-com crash.
That is terrifying. So why shouldn't you, listening to this right now, just panic and liquidate all your tech holdings if the biggest driver of the market is propped up by a circular accounting loop?
Because there is a critical distinction between 1999 and today. During the dot-com bubble, the companies driving the frenzy had zero revenue, massive cash burn, and literally nothing but a .com domain name.
Right, pets.com and all that.
Exactly. Today's AI leaders are established, trillion-dollar monopolies generating hundreds of billions in free cash flow from their legacy businesses. Even if the AI circular financing loop completely unwinds, they have the balance sheets to absorb the shock.
Okay, that makes sense. But Schwab makes a fascinating pivot there. They suggest the long-term durable value isn't going to be found in the AI enablers, like the hardware companies selling the picks and shovels. The real alpha is going to be found in the AI adopters.
Yes. If you are looking at your portfolio, the companies to watch are the legacy businesses in, healthcare, logistics, and traditional finance that successfully integrate AI to drastically slash their operational costs.
Oh, that makes sense.
The market will eventually reward the companies that use the technology to widen their profit margins and leapfrog their competitors, rather than just the companies selling the servers.
But that massive $670 billion AI spend isn't happening in a vacuum. It requires massive borrowing.
Huge amounts of debt.
And when big tech competes with the federal government, who is also borrowing heavily to fund the OBBBA to pull from the exact same pool of capital, it puts intense upward pressure on interest rates,
Yes, it crowds out the market.
which bleeds directly into the exact inflation that Main Street is feeling right now. So what does this all mean for the listener? If corporations are generating record profits and Wall Street is cheering, why is the average person feeling so squeezed?
If we connect this to the bigger picture, we're seeing the consequences of that capital misallocation. The institutional side of the economy is operating on a completely different frequency than the consumer side.
It really feels that way.
Schwab describes our current macro environment as unstable rather than just uncertain. They characterize it as a K-shaped economy.
Okay, the K-shaped economy, which perfectly explains the vipersion everyone is talking about right now.
Yes, exactly.
You have top-line GDP growth, the stock market is breaking records on the upward arm of the K, but consumer sentiment is absolutely in the gutter on the downward arm. People feel like they are in a literal depression.
And the sources pinpoint the exact mechanisms driving that sentiment. Inflation has proven incredibly sticky, right? It's anchoring closer to 3% rather than the Fed's 2% target.
Right.
Furthermore, Schwab notes that tariffs are playing a massive role here, boosting prices on consumer goods by nearly 5% across the board.
And it's crucial to remember how tariffs actually function. Because I think people get this confused. They aren't a tax paid by the foreign exporter. They are a tax paid by the U.S. importer.
Exactly.
And those importers almost universally pass those increased costs directly down to you at the checkout line. It basically acts as a highly regressive consumption tax.
It does. And you see this divergence perfectly captured in the consumer survey data. Have you looked at the University of Michigan's survey versus the Conference Board?
Oh, yeah, the contrast is unbelievable.
Mm.
Are we basically living in two different economies right now?
We really are. The University of Michigan survey, which tracks broader kitchen table sentiment across all demographics, shows deep, pervasive anxiety about job security and the cost of groceries.
Yeah, everyday stuff.
Right. Meanwhile, the Conference Board survey, which heavily over-indexes toward higher-income, market-aware respondents, is showing record optimism about stock prices.
Wow. So if you own a home with a locked-in low mortgage rate and you have a 401k that's heavy in mega-cap tech,
Yeah.
you feel like an absolute genius right now. Your net worth is soaring.
You feel very wealthy.
But if you are a renter relying on an hourly wage to buy eggs and gas, you're being completely crushed by the reality of the downward arm.
And the labor market dynamics are severely exacerbating that divide. We aren't seeing massive headline-grabbing layoff cycles, which is keeping the unemployment rate optically stable, but new hiring has slowed to an absolute crawl.
So people aren't losing jobs, but nobody's getting hired.
Exactly. And the fascinating part is where the contraction is actually happening. Large mega-cap firms are still hiring, while small businesses, those with, say, 20 to 49 employees, are actively shedding jobs.
Schwab specifically points to the recent halt in immigration as a catalyst for that small business contraction.
Yes.
But wait, how does a tight labor supply disproportionately damage a 30-person logistics company while a 30,000-person tech giant just breezes right through it?
It all comes down to margin elasticity and automation. When immigration halts and the supply of entry-level or blue-collar labor just dries up, wages at the bottom of the spectrum have to rise to attract workers.
Okay.
A trillion-dollar mega-cap company has the massive profit margins to absorb those higher labor costs, or they just use their capital to invest in AI and automation to replace those roles entirely.
Right. But a local construction firm or a regional restaurant group operating on razor-thin margins, they can't afford to automate, and they can't afford the wage price spiral.
They don't have the cash buffer.
So they just stop hiring, or they downsize.
Exactly. And as those wages stagnate for the average worker, affordability hits a brick wall.
Piper Sandler, who is cited in the Schwab report, highlighted a pretty brutal statistic.
What was it?
Inflation for core non-discretionary items, the absolute needs like rent, auto insurance, and groceries, has outpaced inflation for discretionary wants for 35 consecutive months.
Oh, man. For almost 3 years, the things you literally have to buy just to survive have been getting more expensive at a faster rate than the things you want to buy.
Yes.
That is the mechanical definition of a vibepression. Your standard of living is actively eroding even if you get a 3% annual raise. Which brings us to the ultimate question facing anyone with capital in the market right now. With this profound structural disconnect between the soaring S&P 500 and the eroding purchasing power of the everyday consumer base, is this entire rally just a house of cards?
That's what everyone wants to know. When does the music stop? Because Morgan Stanley's outlook raises several massive red flags that suggest extreme vulnerability, starting with narrow market breadth.
This is a huge one.
Right. When you look under the hood of these record highs, it isn't a broad, healthy expansion where thousands of companies are growing together.
No, not at all. So market breadth measures the participation rate of individual stocks in a broader index rally. And
Okay.
currently, the breadth is historically narrow.
It's just a handful of stocks,
Right,
right?
exactly. A tiny concentration of mega cap tech stocks is generating almost all of the upward momentum, basically dragging the other 490 companies in the S&P 500 along for the ride.
Wow.
And from a risk management perspective, highly concentrated markets are exponentially more fragile.
Because if one of those giants stumbles, the whole index feels it. And Morgan Stanley also questions the quality of the corporate earnings we were praising earlier.
Yes, the pricing power debate.
Right. Are these record profit margins the result of actual productivity gains? Meaning companies are utilizing AI to genuinely innovate and produce goods cheaper and faster? Or is this just an illusion created by pricing power?
That is the trillion-dollar distinction. Because if companies are just exploiting the chaotic inflationary environment to price gouge consumers under the guise of supply chain issues, that margin expansion is terminal.
It can't last forever.
Eventually, the consumer runs out of savings, credit card utilization maxes out, and demand just collapses.
Factor in that 2026 is a midterm election year, which historically guarantees policy uncertainty and, heightened market volatility. Plus, we're seeing a massive resurgence of retail investors trading on margin accounts, heavily borrowing cash to chase this AI rally.
And margin debt is pure accelerant. It pushes valuations higher during a bull run, but it forces violent algorithmic liquidation cascades during a sell-off.
It forces people to sell when they don't want to.
Exactly. When you combine historically high valuations, extreme mega cap concentration, a squeezed consumer base, and the rising cost of capital, the market is priced for absolute perfection right now.
Meaning any systemic shock, like a hotter than expected inflation print, an escalation in the Middle East, or even just a missed earnings report from a major AI chip maker, could trigger a violent repricing.
This raises an important question, though.
Yeah, so based on the consensus of these institutional outlooks, what is the actual playbook for the listener trying to navigate this? Do you prepare for a crash? Do you just liquidate and move to cash?
Well, panic selling is never the institutional recommendation. However, the consensus from JP Morgan and Morgan Stanley is heavily skewed toward broadening your exposure outside of U.S. mega-cap tech.
Moving away from the crowded trade.
Precisely. They are seeing significant relative value in non-U.S. equities, specifically highlighting Japan and certain emerging markets that simply aren't trading at these stratospheric AI-inflated multiples.
Okay, so look internationally.
And domestically, the advice is to aggressively filter for quality. Look for companies with fortress-level balance sheets, low debt-to-equity ratios, and proven free cash flow. The era of buying a narrative-driven tech stock and watching it go up 300% on zero revenue is completely over.
You really have to embrace the reality of a higher volatility regime.
You do. And you have to assume that the cost of capital will remain elevated. As long as the federal government is running massive deficits and big tech is borrowing hundreds of billions to build data centers, interest rates are going to have a very sticky floor.
Which just naturally brings multiples down.
Right, that structural reality inherently pressures equity valuations over the long term.
So to pull all these threads together for you listening today, we are operating in an environment defined by profound macro divergence.
A tale of two economies.
Exactly. The stock market's relentless upward march feels totally detached from the reality of high gas prices, sticky inflation, and the vibe pressure that's squeezing small businesses everywhere.
But underneath the hood, Wall Street's math is functioning exactly as designed. The rally is being sustained by explosive, highly concentrated corporate earnings, a nearly $1 trillion AI spending boom, and the relief rally dynamics of worst-case geopolitical scenarios basically failing to materialize.
Wall Street is pricing in the efficiency and the profitability of the future, while Main Street is suffocating under the cost of the present. Which, leaves us with a deeply provocative thought to ponder based on the mechanics we've unpacked today.
It's the logical conclusion of the K-shaped economy we've been talking about.
Exactly. If the largest, most powerful corporations in the world are utilizing their record profits to invest hundreds of billions of dollars into artificial intelligence systems specifically designed to replace human capital and slash operational costs, What does the macroeconomic landscape look like in 5 years?
It completely challenges the fundamental relationship between labor and capital.
Could we be approaching an event horizon where the stock market continues to soar endlessly, entirely decoupled from human employment?
It's a staggering possibility.
Imagine a system where corporate algorithms simply trade with other corporate algorithms,
Hmm.
generating compounding limitless wealth on the top arm of the K, while the average worker is permanently stranded on the bottom, entirely priced out of the economy.
It's definitely something to chew on.
It's something to seriously consider the next time you look at that jagged, contradictory disconnect between the price of the gas pump and the green arrows on the stock ticker. Thank you for joining us on this deep dive into the sources today. Keep asking questions and stay curious.